Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, Friday, November 26th. Market pulled me in from my day off. We had done some videos on Wednesday to send out. They all went in the garbage, right? Last day and a half, we've gotten some news out of South Africa on a variant that may be raising its head, a COVID variant, caused some trouble in the market. In terms of today's session, which was probably a bit exaggerated by the fact that it was a half-day session and volume was pinched a bit, but good, solid downward pressure, 2.5%, 3% in most indexes. Some of the areas that are tied to economic growth, like energy, basic materials, and some of the leisure names really took a hit today. Now keep in mind, most of those sectors are coming off very nice moves. So this pullback, to my eyes, looks to be more buyable than sellable. And we'll take a look at some of those charts next week. What do we look at outside of global macro? Well, we like to look at how things are trading, supply and demand. So we have a number of areas that should pop onto our screens in the next 3, 4, 5 trading sessions as interesting. And I mentioned energy may be one of those. If we look at the last 30 days, and there's a chart that I have for you to take a peek at, you take a look at the broad indexes. And we discuss relative strength often. And what you saw again today was the strongest relative strength indexes, the NASDAQ, the S&P, again held up and have held up best versus the weakest relative strength indexes, emerging markets, developed markets. That's been a theme that's been going on for not just months, but years. We'd really like to see some of the foreign markets get more engaged on the upside to give us a little bit more diversification. Right now we're a bit crowded into domestic. In terms of what we think we can look at next week and the next 3 or 4 sessions to tell us how damaging this variant may be to the economy, we need to look at those 3 areas that I mentioned: energy, basic materials, and leisure. When we hit the delta, and if we want to compare this to delta, and I'm certainly not making a comparison from a science standpoint, that's all unknown right now. But we did see some softness. It was mild, but we did see some softness in those areas back in July. Only lasted about 30 days. We're talking about the equity, not the COVID variant. But if we have that as a game plan to go off, we have something to compare to. John will be discussing interest rates as usual. Any kind of fear in the equity markets, any kind of damage in the equity markets that's related to the economy sees a bid go right into treasuries. Treasuries very strong today, rates dropping, bid strong, money flowing. Again, perhaps exaggerated by a half-day session today on the street. But next week we'll take a look at some of the sectors that may be giving us an opportunity off of mild pullbacks behind great strong breakouts. IWM will be one we're looking at. That's that broad Russell 2000. Everyone enjoy the rest of your weekend. We'll be back with you next Friday, but we may be back with you in between now and next Friday with some notes and sharing some thoughts and ideas on what's attractive to us. Have a great weekend.
Hi, it's John Mousseau, CEO of Cumberland Advisors. It's Friday afternoon, November 26th, the day after Thanksgiving. Quick update on the bond market in the wake of the volatility that we saw today. My colleague Matt brought you up to speed on equities, on bonds, concern over the variants of the virus taking hold today. Big move in bond yields down, but limited to treasuries. 5-year up 0.75 of a point with the yield going from a 134 to a 120, down 14 ticks. 10-year bond up 1.5 points with the yield going from 164 to 151, down 13 ticks, and the 30-year bond up a lot, 2.5 points, going from a 196 to a 185, down 11 basis points. And I think it's important to realize, though, that most of these moves got yields down, but they're not markedly different than they were a week ago Friday. So really what it did is undo some of the rise in yields we saw earlier in this week over concerns of inflation and things that we've talked about. The real key as we go forward next week will to watch what happens to yields on other bonds. So for example, today, yields on high-grade bonds and corporates hardly moved at all, which meant that they widened to treasuries by somewhere in the neighborhood of 10 to 15 basis points. Clearly, bonds that are backing, travel, leisure, those types of companies probably widened more. On munis, really no change today. In fact, they bumped scales a little bit. So they didn't keep pace with treasury yields, but their yields did come down a little bit. We see this a lot when we see these kind of movements in treasuries that are fast and happen in usually a few days. And what we normally see is we see corporate spreads widen, and we don't see the yields widen on munis, which really goes back to how much we as a firm use taxable municipal bonds in our IRAs and foundations and the like. And it really pays off when you get these kind of events. We don't know how this will transpire further. We're going to watch it next week and come back. We hope you all have a great weekend, but we wanted to give you that update. Have a nice weekend.